boy! Guys, ready to go? My 98s are booming in my trunk with funk. All you punks can't stop my dunks. All right, hey, good morning. How are you? Oh, man, you look good today. Yeah. All right, I got to move this over there. Hang on. I got to kill this. I got to move this over there, move that over there. There, I think I'm ready. All right, so, yeah, let's get on with it. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. But with that being said, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Hey, there you are. Good to see you. Hey, my name is Wayne. I'm a currency trader just like you. Trying to get my Bank of England on. BOE, baby. So let me know how I can help. I've been trading for, well, a couple of decades. Before that, I was a venture capitalist. And before that, I was a high-tech entrepreneur. Before that, I worked on the nonprofit world. Before that, I worked at Apple, Cisco Systems, and NASA. Before that, I had a paper route. Cool. Sky Killer says, Bank of England used to have two guys not wanting to raise. Now only one. Yeah, that's right. Good call. Nice pick. That's true. Anywho, great. So, yeah, we got the BOE, so we're just going to watch that today. Very cool. Everything else should be self-explanatory. Boy, that pound yen was really great. Nice. But anyways, like I was saying, let me know how I can help. I have an education background focused on macroeconomics and all the trading experience. I love technical analysis. I like to scalp, spot, swing, carry position. So, yeah, I think you should be well-rounded. Also think you should be on the get-rich-slow path. To do that, you need to build a sustainable business that creates value. Okay? Right, cool. So we can talk about all of that. Yeah, you tell me. Now, there are links to resources in the description below the video, so why don't you click the thumbs up button on the way down, and then you can take a look at the links. Things I'd like to point you to. There's a link to my book. Check it out. Some say it's the worst book ever written. Well, that's pretty extreme. I mean, that's really hard to do. So, I mean, there are bad books, but my book is the worst book ever written. Not bad. No mediocrity here. So that's cool. So you can leave a review if you'd like. There's a link to investorbootcamp.com where you can watch training videos. 100 hours of training videos. Technical analysis, fundamental analysis, monetary policy. You can even learn what a heater treater is. Yeah. You ever wondered, like, how to frack? You're like, I don't understand this fracking stuff. Oh, yeah, you can learn that at investorbootcamp.com. You can visit, let's say, how about Trade Plans AI? Huh? Anyone tried tradeplans.ai? You can post a trade plan and in less than 3 seconds get feedback. And it's truly amazing. You got to try it. It's free. I built it. You can use it. Try it. Tradeplans.ai. There's QuantBox, quantbox.co, a process where you can automate your macroeconomic research, not just economic quantitative analysis of economic data, but also market data, right? So like market sentiment on the short, medium, and long term. It does things like technical analysis. Like, it's really amazing stuff. Does central banking analysis. It tells you retail positioning. It tells you institutional positioning. Really cool tool. And it just automates all that complex work. So you try that, quantbox.co. Try tradersway.com, a trustworthy, ethical foreign exchange broker. Every single one of us, whether you use your technical analysis only, fundamental analysis only, right? A hybrid. Maybe you do no analysis at all. Doesn't matter who you are, how you trade. You do need a broker to execute your trades. Some brokers, if not most brokers, trade against you because they think you're stupid. They call that B-booking. And then there are a few, but not many, brokers that actually just execute your trades into the interbanking system because they treat you with dignity and respect. Well, that's a proven fact as far as Traders Way. They execute your trades. Now, I never actually sat down with the leadership where they're like, we don't do any of that. No. They didn't tell me to say that. When I first started working with them, there was a period when the Swiss National Bank pulled the plug on their peg to the euro. And it was so dramatic that a couple of the biggest foreign exchange brokers in the world for retail traders went out of business that day. That day. Boom, that day. Two of the biggest. And what that proved is those brokers were trading against their clients. Manuel, I didn't say who. I'm not here to poo-poo on others. What I'm trying to say is it actually happened. And, well, what about Traders Way, a tiny boutique foreign exchange firm? They're not like, they don't have 30 or 40 or 50,000 traders all on one little MT4 server. They're a boutique. So what happened to that little boutique firm? So I contacted them. They're like, we're fine. I'm like, are you sure? Big brokers are going out of business. They're like, well, we actually executed the trades like our clients asked us to, so we don't have any of the risk like that. I'm like, really? You actually do what you say you do? You're like, yeah. I'm like, you know, that makes you unique and special. So anyways, they earned my loyalty and respect right then and there. Okay, so there you go. You can check them out. That's why I recommend them. Okay? So tradersway.com. Again, all of this is in the description below. Okay? So, anywho, let's get on with the BOE. Pachow. I had it over here somewhere, both the site. Well, here's the site. This is the link. I guess this is it, because I was doing this last night too. So I just want to double check that's the right link. I think that's the statement to today. If not, that was the link to what I was reading last night. And then I thought I had it running somewhere else. Guess not. I can't find it. Or maybe it's right here. Oh yeah, there it is. Is it over now, or do we still have it?
As chart 5 illustrates,
Yeah.
in the MPC's projection for consumer price inflation, which is conditioned on the market price for interest rates, inflation is more likely to end the forecast period below the 2% target than above it, albeit slightly. In the modal, or most likely case, inflation is
By the way, you
1.7%
see this?
in 2 years'
This
time,
goes into quant box.
and 1.5% in the third quarter.
If you're
of
like, how do they figure out
2026.
inflation going out to 2025?
However,
this is the
committee
type.
continues to
This is
judge
where
that
we get
risks
this
around that
information.
central case are skewed towards higher inflation. Adjusting the modal projection for the balance of those risks, the mean or expected path for inflation is close to, albeit just below, the 2% target towards the end of the forecast period. Now, the projection for inflation is broadly similar on the alternative assumption of a constant level of bank rate at 5.25% throughout the forecast period, and that's discussed in the report. And this illustrates that different paths of bank rate can secure a return of inflation to the target. The market curve is higher than the current level of bank rate in the coming quarters, but then falls below it further out, averaging just under 5.5% over the next 3 years. Now, a lot will depend on what happens in the labour market and to pay. There are signs that the labour market is loosening. The unemployment rate rose slightly to 4% in the 3 months to May, and the ratio of vacancies to the number of unemployed job seekers, the so-called VU ratio, an important measure of labour market tightness, has continued to ease, as shown in chart 6. But the labour market remains strong. The VU ratio is still significantly higher than before the pandemic, as you can see on the chart. Annual private sector regular pay growth increased further to 7.7% in the 3 months to May. And this is materially above expectations in the May monetary policy report, and notably stronger than standard models of wage growth based on productivity.
I like the water
short-term
decanter.
inflation expectations and tightness in the labour market.
The British are classy, huh?
So chart 7 gives you a sort of brief sort of insight and sort of line of sight into sort of more of the entrails of the process, if you like, because what this chart shows is a swathe, which you can see in sort of light grey, illustrating the range of forecasts that we derive from the suite of wage models that our staff maintain. And then you can also see in the line the MPC's projection for private sector regular pay growth, wage growth. That line and that projection is our best collective judgment on the committee, and you can see that wage growth is expected to ease more slowly in that line than the models would predict. So what we have here in a nutshell is that the empirical models illustrate what might happen if wage setting will be based on inflation expectations that take account of the downward path of inflation over the near term. But the best collective view of the committee is that we don't have enough evidence at present to be sure that wages will be set in this way. And in our judgment, upside surprises on wage inflation suggest that it will take longer for second round effects to go away than it did for them to appear in response to the sharp rise in prices of many imported goods over 2021-2022. And interacting
Sky Killer, I think you would enjoy the Reserve Bank of New Zealand press conferences.
And with it in the cost pressures that determine price setting in the economy. Now, I also show this chart because the difference between empirical model outputs, and I will put models in the plural here, and the committee's best collective judgment, which is obviously clear here, is, I think, one illustration of the importance of reflecting on how our processes should adapt in a world in which we increasingly face significant uncertainty and large shocks. And so with that in mind, I'm delighted, as we announced recently, that Ben Bernanke has agreed to lead a review into the bank's forecasting and related processes. As you know, Ben is a renowned and award-winning economist with a distinguished career, and I think he's an ideal person to lead this review, which is really, what lessons do we derive from this type of situation, and what do we do going forwards? So let me conclude on today's policy decision. The news to wages and its implications for inflation persistence should be seen within the context of the overall data news since June.
By the way, if he had a bespoke suit, his tailor could make it so when he sits like this on television, his jacket doesn't do that.
As well as wages. The MPC responded to this evidence of more persistent inflation pressure by increasing bank rate by 0.5 percentage points at the June meeting. Since then, While pay growth has come in stronger than expected, other data news has been more mixed in terms of its implications for the persistence of inflationary pressures, and thus the outlook for inflation over the medium term. And that's why the MPC has voted to increase bank.
I'm wearing an Omega. He should be right. Wearing a British watch too.
Now, given
Not
the
an
significant increase in
iWatch.
bank rates
Come on,
since the
dude.
start of the tightening cycle, the stance
Not a
of monetary
Cartier.
policy
You don't want to
is
wear a French watch,
restrictive
but a good Omega. That's what he should
The
have on.
evidence is now clear that it is having an impact. To return inflation to target, policy needs to continue to be restrictive, and today we've taken a decision that's consistent with that, which will help to return inflation to its target. I'm not going to judge what the path of rates will be, not least because, as the report indicates, more than one path may deliver inflation back to target sustainably. We've taken a decision today based on the evidence we have, and we will go on judging what is most appropriate based on the evidence we receive. The MPC will continue to monitor closely indications of persistent inflationary pressures and resilience in the economy as a whole, including the tightness of labour market conditions and the behaviour of wage growth and service.
I'm going to run an ad so YouTube can make money, but I'm already kind of like slapped for today because they're not going to allow this, so the money's going to go to somebody else. So I'm not doing it for me. I'm doing it for YouTube, just so you know.
To return inflation to the 2% target sustainably in the medium term, in line with the remit. So with that, Ben, Dave, and I will be happy to take your questions. Thank you.
When you get a hold of the microphone, please let us know what your name is.
She wearing
where you're from,
snake
and
skin?
if you could limit it to one question each so we can get around to everyone, that would be great. We'll start with Ed, and then we'll go to Sue.
Is she really? Good for her.
Thank you, Governor. Actually, so some of your final words there, you were talking about, you were kind of echoing something that was in the minutes about having rates sufficiently high for sufficiently long to bring inflation back to target. I just wonder, can you expand on that a little bit? Because there are many households out there, they're looking at interest rates, they're hoping that after they were high for a while that they would start to come down. Are you saying that actually we need to be prepared for interest rates to be high for longer than a lot of people might be expecting right now?
Well, let me start. I'm sure Ben will want to come in. It's worth starting, I think, with the market curve because, of course, the market curve does have a fall in interest rates, but it goes higher before that happens. And I made the point in the opening remarks about what that delivers as an average rate over time. Now, there are many potential paths, but we have also shown, as we always do, but I would draw attention to it, what happens if you do the constant rate. So you assume it's constant at today's rate, which is another potential path. And that delivers, again, a return to target. So the point I would make is that we have to balance the risks here. We've got risks both ways, I think. There are inflation risks, certainly on the upside, which we've reflected in the mean projection. I would highlight, and Ben may want to come on to this point, that relative to May, more of the risk that we saw in May we think has crystallized and is in the modal projection, but we still have a mean projection. It's just a smaller mean projection than we had in May. But we're also, of course, conscious
Modal.
that...
Is he saying model?
the projection for activity has weakened.
The modal. I'm going modal versus mean. Modal versus mean. Oh, maybe it's model. And the model suggests a mean.
As Andrew says,
Look at her power pose. She knows what she's
doing.
doing. I liked it. I don't even know who she, I have to look her
One particular
up.
point, I mean, there was a lot of focus in May on mortgage costs. Those mortgage costs respond much more these days, given the shift in maturities to 2 or 3 year interest rates than they do to the overnight rate and the bank rate. And that's one illustration of how there might be lots of powers that keep that 2 year rate roughly stable. And you talked about what people expect. At least 10 seconds before we came up here, we had a look at the reaction of the market curve and specifically of 2 year interest rates to today's decision. And they moved very, very little. I mean, immediately before and after the decision, I think they were down 3 basis points.
So he went with the gray suit with the gray tie.
Or that point, which I think was well worth making, has had a tremendous decision on that 2 year interest rate, or therefore the equivalent, say, quoted mortgage rates, or indeed 2 or 3 year interest rates facing businesses, which also matter.
And if I could just add one final point, where
where we go, which path we end up being on, as Andrew stressed,
He went
at the
with
end of
light
his
gray
remarks,
with dark
will
gray.
depend on the evidence.
But
and on
see,
the evidence of persistence.
They all
That's-
have cheap
that's what's
suits. Look at
driving
it.
the
Look,
decision.
look at the shirt he's got with the collars all turned in. It's not good.
A lot of the upgrades that you've made to your inflation forecasts in the latter part are to do with the MPC recognizing
These guys
some of
should
the
be sharp.
risks
I mean,
to
come on, they're
inflation
British
that
bankers.
you've
Come
warned
on.
about in previous forecasts are in fact starting to happen. Why are you only fully?
I mean, it looks
starting
like he
to
didn't even have his
recognise
shirt
these
dry
risks
cleaned.
now, given these pressures
It's
have been there
strange.
for months? And I was really interested in that wage growth chart and your judgment that it will remain more stubborn. Is that the first time you've moved so markedly away from traditional modelling and models?
Well,
Models.
I mean, actually, so if I don't have them with me, but if I showed you the chart, the same chart for last time, the line would have been sort of near the top of the swathe, and we've been near the top of the swathe for quite a while, actually. So there is a move, and as you can see, obviously that move reflects the evidence we've had since May in terms of the outturns. I just come back to emphasise the points I made in the remarks, actually, because I think this is a really important point. And it's what links the first half to the second half of the sort of these two parts. If the fall in inflation that we think now is going to happen, we think with more confidence is going to happen this year, translates into inflation expectations. And if those inflation expectations translate into wage bargaining, then I think you will see there is a possibility, or a risk as we would say, but a possibility that line will actually go down and go nearer to the swathe, because the swathe puts a greater weight, for instance, on inflation expectations. The question that in our mind, as I said, is what confidence do we have of that happening? Well, to answer your question, your question sense of saying why only now we've seen evidence, I think, in the last couple of months that that element of the labour market, the other parts of the labour market I think are softening, but that pay element of the labour market hasn't. That's the point I would draw out.
See, what he's saying
So you
is
can see from that, in a sense, that
expectations
although,
of inflation in the future.
I never want in these events
that's
to
not
say
a
there's only
now
one indicator
measurement,
that matters,
that's
because that's not true.
a
obviously.
future.
It is an important point.
And they're
in the
saying
future part.
if people think inflation is going to be higher next year, then inflation will be higher next year. And that
risk
diminishes
crystallising.
their future guidance.
That's the first time we've used that word in this context, but the risks on persistence have been crystallizing prior, through this year. That's why we've been having to raise rates.
See, look at the
Response to
shoulder of the
increasing
suit.
evidence
That's
of
bad. You see how it pops
So
up
it's
like
not
that?
Suddenly that evidence has appeared. We've been
And then you
seeing
look
that
at the
evidence
his shirt
for some
collars are
time,
turned in.
which is why we're
Yeah.
having to keep raising rates.
Can we go to Faisal and then Halia?
It's like $100 suit.
Hello, Faisal Islam, BBC News. Just can you explain why you've used that new language on bank rate being sufficiently restrictive for sufficiently long? Are you concerned that households may have become a bit accustomed to zero rates over 15 years and may expect rates that 5% is the aberration, and may expect them to fall if inflation falls back to target, and that's not going to happen? And does it also implicitly suggest that rates are very close to peak, that you're having to make this
Yeah,
statement?
good question. This guy has a good question.
Well, I'm sure I want to comment on that. Let me
Okay, listen
start.
to this.
I think let's start with where the word restrictive, in a sense, first gets used, which is to describe the stance of policy as of now and how we think policy is working through. And the policy, as I think I said earlier, is having an effect. And I think that's the important starting point for this. You'll be aware that obviously both the Federal Reserve and the ECB have used the word restrictive, and we've used the word restrictive, not because we love to sort of use the same words, but because actually I think it's a reasonable description of where we all are at the moment in terms of the way monetary policy is working. And of course, given the lags in the effects of monetary policy, it's not necessarily surprising that it's taken some time for this evidence to come through, but we now think it is coming through and we see it. So that's the starting point. And then I think that you're right to say the comment at the end is to say, in order to get inflation back to target, we are going to have to, in a sense, keep this stance of policy. But I want to just emphasize again, and I'll hand over to Ben, that this stance, can incorporate a number of, quite a lot of different paths of interest rates. I think that's a very important point to make.
But I think they mean
It's
no
not quite
cut.
true to say that the forecast depends, and the forecast outcomes for inflation at 2 or 3 years depend on the average level of interest rates until then. But it's closer to the truth than it is to say they depend on the interest rate only today. As I was talking with Ed, for example, that 2 or 3 year interest rate, market interest rate, is more important than it was as a driver of private sector interest rates, for example. We have to make sure inflation comes down sustainably to target, and therefore we have to be focused on making sure that that average interest rate, given the information we have right now, is sufficient to ensure that happens. Now that can change. It's not as if we're fixing the entire path of interest rates forever today, and I can't say exactly where the peak will be, we don't know. But our focus is very much on the medium term, and we have to ensure that interest rates over that period are sufficiently restrictive. So I don't think we're saying any more than that. We didn't have in mind somehow that households in particular were underestimating the risks. Households right now and have been facing 2 year interest rates, have for some time been facing 2 year interest rates that are markedly higher than they have been for decades, frankly. So I don't think that was our particular reason for saying this.
Channel 4 News. Good afternoon, Governor. You talked about there being some good news at the beginning of your opening statement, but we've got slower growth, higher unemployment, higher bank rate. Inflation looks more challenging. It sounds like the wage price spiral looks like it's crystallizing. What's gone wrong with the economy, and has the bank lost control?
That's a
Well, I
loaded
agree with
question.
that, Helen. I mean, to start with, the good news is that, I said it a few minutes ago, that I think the path of inflation in the first half is now much more assured. The number that we saw a couple of weeks ago, to be frank, was a number that we had thought would happen. I showed you earlier that chart, which, for instance, on goods prices, which compared producer prices to consumer prices, and as you can see in that chart, there's a major puzzle in that chart, a really major puzzle, as to why you've had this dislocation between consumer and producer prices. And it's been puzzling us. We really had thought that we would start to see evidence of that fall sooner, but we have seen it now. Now, of course, you can never put too much weight on just one number, but I think it's not an aberration as a number. So I think it is a sign that inflation is coming down. As I said in the opening remarks, because of the way the UK energy policies work, there are 2 quite substantial base effects to come, and those base effects are annual effects. And there would have to be a massive change in energy prices to take those away now. So there is, I think, a much more assured path downwards of inflation, and that's a good thing. As far as the second half of the forecast, where obviously, as I said, policy and judgment in terms of how policy will work and how we should set it comes in. I mean, let me sort of give a bit of a counter view. The economy has been much more resilient. Now, that's good news. I mean, that is good news. We have to then set policy to, in a sense, work with it. But the fact that, for instance, we were sitting here, back last November, saying we thought it was going to be a long but shallow recession.
Maybe Ashish. Well, I point
A lot of
these
that
things
was based
out.
on energy prices at the time, which obviously you remember were much
Matt,
higher.
because many of you guys want to run a
That
hedge
is not
fund one day.
transparent.
And you need to be
We've
able
had
to walk into a room and know which person has a $100 suit and which person has a $1,000 suit.
Yes, we have seen some
'Cause you-
increase in unemployment.
If you're trying to
But
raise money,
unemployment
maybe the person
remains
with the $1,000
historically
suit
low.
does money.
That's a good thing. So we all want to see that.
You should be able to just look
So
and know. Boom.
I would give you the counter view and push back. There are there are arguments, that you can definitely put.
It's not necessarily true, but it is helpful. You need to know the difference between a bespoke suit, an expensive off-the-rack
Thank you,
suit,
Governor.
and
in the run-up
cheap
to
crap.
the June
It
50
might be
basis point
informative.
hike, we saw 2 upward surprises in CPI. Going into today's decision, we had 1 downward surprise in the CPI figures. I have a question about your reaction function going forward.
But you might talk to
Are
a
you likely to
multimillionaire
place
with a
more
cheap suit.
emphasis on
Now you know the
where
conversation
inflation
should
numbers come in
be
relative to your own expectations? Or are
conservative.
you watching the evolution of domestic
focused.
inflationary pressures?
Because
things like
obviously they
services,
don't
service
burn
price
money.
inflation, wage pressures,
So now you know the
more
personality.
than
Guy's got
where the
$100 million
headline number
in a
comes
cheap
versus your
suit. So
expectations?
Well, I think my
don't
first
go
answer
in
will
hot
be
about
probably to that question, because I don't think the way you set it
spending
up
money
is sort
and-
of in
and
conflict.
amazing expectations.
I mean,
The
I think
guy
what
is
we always have to
conservative.
do
The
is
gal
that
is
we
conservative.
have to sort of
Adjust
look at the
your
news
conversation.
and of course then judge
So you got to be able to read the room,
how
right?
the news, you know, in a sense, sits against where we thought things would go to. And as I said, I think
Talk about how prudent
just
you
to put
are,
that into
how
context,
conservative you are, how disciplined you
as
are.
you rightly say, we had some quite large evidence in June, which was quite clearly at odds with the view we took in May. Today, I would say we've seen, you know, one thing sort of correct itself and one thing not correct itself in a way. That's the way
Maybe.
it's up. So the one thing that
Depends on
corrected
the room
itself
that
is
you're in, though.
actually
But yeah,
headline inflation.
that could be true
Because
too.
in fact, headline inflation on the latest number is pretty much exactly where we thought it would be in the May forecast. The components, though, are not quite the same. The thing that hasn't corrected itself, coming back to some of the earlier discussion, is pay and the labour market particularly. And you see some of that also in services prices, although I did make that caveat that there's a sort of there's what looks like a possibly non-persistent bit of services, and then there's a persistent bit of services, and you've got some of both in there. So I think what I would putting all of that into context, we had some unpleasant surprises in June. We've seen some of that turn around, which is frankly.
Is that right, Maida? I can't get it. Their mics suck.
I don't think.
Can you hear every time they touch the table, the
Personally,
mic
no, I
goes
don't
really
think that's the
loud,
case for
and then they lean back and you can't hear them? Like,
But we have still got.
it's really poorly
there's
done.
Very clear risk.
I can't get it louder. That's max.
Well summed up by some of the charts. So so I don't think your question is really at odds in that sense. I think both things have to come into play.
And if I could just add, Andrew, on that, I thought your presentation brought out that difference between our focus in the presentation.
He's got an
for the
expensive
remainder of
watch,
this
though. I
year
think.
is on those short-term.
Is that a
forecasts
Panerai?
Where we publish a lot of detail,
Haha.
including
See?
on the components.
$100
of
suit,
inflation,
$15,000
as well as
watch?
on wages. And so when
You
it
think
comes
this?
to our
So
reaction
now you got to talk
function,
conservative
we
with
can
this guy.
track those three indicators that we've highlighted.
Dude, is that really a
services
Patakin
inflation,
a
labour
Panerai?
market tightness, and the third metric, private sector regular wages, against those short-term developments. That's what we were doing in May. That's why June we brought out that difference.
I can't quite see it. I think it is. That's a Panerai, isn't it? Oh, right on, Maida. I'll try. I'll look it up. Yeah. That's a Panerai, isn't it? Yeah, maybe, right? Okay. Your customer says, why even carry it? Well, men don't wear jewelry. So this is the only jewelry you could really wear in a professional environment for, someone that looks like this guy. Imagine if this guy had a diamond earring. Someone else might be able to pull that off, not this guy. But I don't know. It's interesting. So, like, if you were talking to this guy, this is exactly what I was saying before. This guy doesn't waste any money. He is conservative. Like, yes, he's a banker. Okay, he's conservative. But if that's a Panerai, he has money and he does spend it. So what can you learn about this guy? If you were trying to raise money for your fund, Are you going to go in and talk about you're going to make, 50 to 100% a year? You got this guaranteed investment that you're just going to crush it and make this guy rich? No, that conversation would end in about 2 seconds. This guy is prudent. Does he waste money on a haircut? No. Does he waste money on a suit? No. Does he even have his shirt dry cleaned? No. Look at the callers here. He doesn't even, he's on television. He's running the Bank of England. And he won't spend £3 to have his shirt dry cleaned. But a £10,000 watch? Let me see if I can find this watch for you. Panerai, it's a Panerai GMT stainless steel, I think. So Panerai GMT steel. Let me see if I can quickly find this watch. And I need to find it in leather, right? Oh, look at that. I nailed it almost exactly on the price. It's this, right? Oops, come on. Okay, see how it comes way out here? These have thinner hands. Mine has thicker hands. Yeah, isn't it? See how oddly thick it is over here? He's got the thicker hands. These typically have thicker hands. Yeah, okay, this is probably a better model. Right? Okay, the thicker hands. You see how pops out here? Right? You see? He's got the brown one. And they do make a brown one. I like the brown one, in fact. Can I find an example of a brown one? Let's see if we can find his exact watch. But I learned this trick in Dubai, actually. I was having lunch with a reporter from the area. And I said, hey, man, this is my first time in the Middle East. I said, everyone dresses the same in casual or in conservative dress. I can't find the brown one, brown face. Yeah, forget it. I forget it. Anyways, that's close. And he said, the watch and the shoes is what he said. I lost our... Okay. The watch and the shoes. No, I already have one of these. I don't have it in the office. Maybe I do. I leave them laying around very often. But anyways, so like going back to this, first impression, like this guy doesn't have any money, but then boom. All right, he does have money. But he doesn't waste it, he doesn't spend it, but he does invest it. But it tells you his personality. Okay? He's conservative. You understand? You have to mirror this in your conversation if you're going to raise money from a personality like this. You want to go slow, you want to be prudent, you want to be conservative, you want to be disciplined. You don't, right? This guy will want control all the time. Okay? And he probably won't invest, and you don't want to sell him. You're not going to convince him of anything. The more you try to convince him, the less likely he's going to do it. And then when he becomes a client, he will check everything. So when you send out an email or a newsletter or an update and there's spelling mistakes, it will irk him. And then when you send out a spreadsheet, he will look at every cell. And if you can't roll with an investor like that, then you should not take money from an investor like that. But he might be the best investor ever because everybody lets him down. He's not happy with anybody. This guy can't have fun at Disneyland. Well, neither can I, actually. I hate Disneyland. But you see what I mean? Like, so if you can roll with him, if you can maintain a relationship, a client, professional relationship with this guy, he will, I don't know if he'll bring more money, but I don't know. I guess you should aim to please him. Everyone else will be easy. Right? But this could be a good client if you got A game. If you're a sort of a B game person where you're like, good enough is good enough, this guy will be a challenge for you. He probably won't invest. Okay? But he might have a lot of money in that case. Because think about it. Like we talk about this in personal finance. He doesn't consume. A suit is consumption. Dry cleaning is an expense. A watch could be considered an asset. Okay? You see? So he might have a lot of money because he never wastes it. He always invests it. He's very conservative. He's very focused on a return. He's not playing games. He's serious as a heart attack. And I get that in seconds.
Focus in the presentation for the remainder of this year is on those short-term forecasts where we publish a lot of detail.
It's really hard to see that.
Including on the components of inflation as well as on wages. And so when it comes to our reaction function, we can track those three indicators that we've highlighted: services inflation, labour market tightness, and the third metric, private sector regular wages.
Yeah. Anyways. Yeah. I'll leave that link. Okay. I'll leave the link with you, all that kind of stuff. Let's go through some charts and then call it a day. Remember, if you're a member of a live group at investorbootcamp.com, we have a 4:00 meeting called the Swing Trading Group where we do collaborative work, teamwork at 4 p.m. today. Make sure you got that scheduled. Hang on. Teamwork. Hang on. Maida, did you email me? I don't see it. Anyways. All right. All right. Let's go back. Let me close that. Let's open that. All right. So let's take a look. Pound coming down. Okay. Apparently money going to Europe. Dollar has been strong. Okay. Giving back a little bit in the moment. Yen strong. There was a great pound yen trade. We set this up last night in the day trading group on the pig, on the beast. Look at that trade, guys. From the day trading group last night. Oh, God. Look at that. Oops. Look at that. a little on the fat side, huh? Don't you stink? All right. Look at that. Wee, wee, wee. Oh, my God. So anyways, now we're in the bullish buy zone. So if you're a bull on yen pairs, it might be a little early, but this is the bullish buy zone. Okay. Okay. And which is the equal and opposite to this zone, which was the bearish zone. These zones shouldn't make you bullish or bearish. You should be bullish or bearish for fundamental reasons or seasonal reasons, which is a form of it, right? So that's the sell zone up there. So bears are done. They did their job. If you're just doing it now, you don't have a game. You're like you're so ridiculously late that you're now selling into a buy zone, which is not good. But you could maybe try this if you were a bear. Okay? But you should recognize that if there are bulls in this market, they're just starting to be interested. They'd, in fact, like it to go a little further down. So I think there's a lot of bulls near 80. What do you think? So I think a lot of bulls would kind of love to have this like come down to about 80-ish and then roll that way. So anyway, so be careful, bears. But bears, last night, you had a beautiful trade. It was just gorgeous. Just gorgeous. Okay? Selling the rip is what we were talking about last night. Richard said, did Japan do a small intervention? Well, you might be getting that from media. It's not intervention per se. Intervention isn't the right word. They're just doing open market operations of yield curve control as specified. Okay? So they're just doing their job, and they already told us what they'll do. So, yeah, I believe that is correct. Okay? So anyways, that's not what that move is, because intervention, as you say, or see, what used to move the market is that we had a fixed yield at 5.0, and then the central bank of Japan would push the yield down. That we can see on. Okay. We're in a situation now where yields are rising and the central bank is pushing it down. But the pushing of it down isn't necessarily creating the weakness. It's the fact that it has to be pushed down because rates are rising. You see how there's a little bit of a difference? There isn't a ceiling for rates of maximum value and then potential decrease in value. Right now, it's the central bank is trying to decrease value in a trend of rising values. And that rising value pressure is what creates yen's strength. We didn't have that before because the line in the sand was 0.50. Now there isn't, have they even told us there's a line in the sand? Do they give us a yield? And I don't think they have. It could go to 1%. That's the strength. But also, and this is like a major part of what we discussed last night, okay, this is what typically happens every year. This is natural. You can't stop the seasons. Okay. Okay. So you got to have that going on too. Oh, you thought Forex was easy? Uh-huh. Okay. A big part of what we discussed last night in the day trading group is the top. And not just the top there. We were doing the correlation setups and the top here. Okay. So if your trade plan is this, then you're taking that pound yen down too. You see, like there's a deeper thought than just look at the green candle, look at the red candle. Oh my God, look at the news. Oh, look at that. There's a lot more going on. Okay. Oh, Johnny Wise says, hey, he can sharpen your game. I know what you're referencing there. That's exactly what I was saying. But if you can't, like some people just don't have that, then you should stay away. Most likely what you'll need from this guy is a referral and then do well to the referral, then have him come in. Like he's not going to be an easy guy to get on board, but he might end up being one of your best. Your customer said that 1%, but I think they said up to. Okay. But yeah, I had 1% in mind, but I don't think it's a hard number. So last night, again in the day trading group, we were talking about this, and I was comparing it to merger arbitrage. And when an acquiring company is trying to take an acquisition off the market, and the acquisition company, the company to be acquired, has a stock price of $20, the big company has to come in and say, well, we intend to buy this sucker at $24 a share. And as soon as that happens, the price goes to $23.80, like almost exactly 24, because it's a hard number. So the idea here is if 1% was the hard number where they said, we will let the JGB go to 1%, well, then we would have been at 1% within a day or two. And in a day, we went from 0.5 to 0.6. So and they've been intervening at like 0.6, 0.63, 0.65. They've been intervening there, if that's the language we want to use to describe their open market operations. So they're not. It's not 1%. It's up to. What I had said when it was announced is that they don't know what will happen, and this is sort of an experiment to see what would happen to the markets if they were not spending all this money holding it at 0.5. Maybe they can spend no money and let it go to 0.7 and still get the same results. Okay? Right. So it's sort of like testing the waters. Okay, your customer, in my opinion. Okay, cool. Okay. So anywho, stock market, yep. Okay, next target, 44.44. Cool. Nice. So that's setting up properly. Then we go look at our dollar pairs. And my Kiwi dollar now has hit target. Yeah. Yeah, this is last week's trade. Guys, it's Thursday. This is last week's trade. Done. I'm smoking hot like fire. When I turn, you desire. I'm fresher than you because you white. I ain't lying. I ain't dying. Up to number 1 is where I'm flying. All right. Check that out. Not quite to the top yet. Not a perfect trade, but remember, the reason it's not a perfect trade is we did this first. Up, down, up. What actually happened was up. Oops, I wanted that in red. Up, down, up. So now we have a down, up scenario. Okay? But it's the same idea. You want to look there, and somewhere in this box is your buy. Plan A is what I had. Okay? Plan B is the double bottom, but it's all a zone. You know how I like to trade zones. And your stop's got to be lower than support. And so now we have a higher high. Okay? And you can move your stop, if you will. Certainly like here or here, wherever your entry is, move your stop. And ideally, this is what happens next, but obviously, this is legit. Okay? Cool. Okay, riding a 21 here. Do you remember the target on euro dollar? Let me explain it to you again, Lucy. Let me explain it to you. Okay, check this out. Okay, top. That projects a bottom. Okay, of 1.07. There's still 300 pips to the bottom. Up, down, up, down, 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 down. Okay. 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 Cool. Euro ZAR. We're not doing Euro ZAR. Do some commodities. I got a meeting pretty soon. I'm going to have to go. Bitcoin. Okay. Still not up. 30 still holding. Still trending bearish. Stock market already showed you. My WTI. We went all the way to the top of the range and now has fallen. I have a buy zone around 77, 78. I guess it's 78. It dropped to 79 and is now rallying. So you may have missed it if you're a bull. I would have liked something closer to that first. But you're so nitpicky. Okay. Still, pay attention. The reverse fib is still likely, and you'll have a new chance later. Okay. Gold. Some of you guys have gold. Great. I'm a disinflationaryist. Okay. I'm a disinflationaryist, and my target for this is back to 18. Yep. Okay, back to 18. Cool. All right. Two more things. One more thing. Two more things. Yeah, I want to remind you again, if you're in my day trading group or my live swing trading group, we all meet together in the swing trading room for our collaborative work together at 4 p.m. I'm really looking forward to it. It's a highlight of my life. I had a small emergency last week, so as soon as we got going, I had to bail. Let's just say somebody close to me set my Porsche on fire. And, well, I had to go. So we had some drama. Yeah, it was a very dramatic. Last Thursday was not a good Thursday. But Thursday is usually the happiest day of the week for me because of our opportunity to get together and how amazing our swing trading group is. Hey, mate, I ain't pointing no fingers. Yeah, but if anyone wants to buy a slightly used Porsche Cayenne GTS Magnum with slight damage in the engine bay, yeah, that's right. Well, technically $99 a month. Yeah, that's right. Cool. So anyway, so that's today. And then tomorrow, I'm over at FX Street for Trade Non-Farm Payrolls Live. I don't remember what it is. I can't even tell you if it's 200 months or it's more than 100 months. Is it 200 months? 200 something months? Yeah. So anyways, about 17 and a half years I've been doing that webinar on a regular basis. Okay. Yeah. So I'll be over there. And then I'm doing more of a regular thing over there too now on Fridays for their premium group. I'm over there for kind of like, I don't know, it almost feels like a podcast because it's more of just a conversation. Luis says 207. Okay, yeah, 207 months I've been doing that. Yeah. I just got a shiver all of a sudden. So anyways, yeah, another wonderful week, another busy week, another important week. But I'd like to thank you because there won't be a live stream here tomorrow because I'll be at FX Street for non-farm payroll. So I want to thank you for being part of this community. And this is sincere. I want to thank you for being part of this community. And the banter that you and I have on a daily basis, and sometimes it's technical, sometimes it's fundamental, sometimes it's psychological, sometimes it's just babble. But I like what we do. I hope you appreciate that I really do try to teach. I hope you like the fact, and I think you do, many don't, that I don't just make this about, hey, watch me trade and you do what I do. Let's all get rich quick, models and bottles. I hope you appreciate that. Okay? Yeah, I hope you appreciate that because I do want to make a lasting difference. And I don't want you to have an illusion that this is easy. But I do want to give you a reasonable idea of the ridiculous, sickening work ethic it's going to take. And if somebody says to you, instead of buying a sports car during your midlife crisis, instead you should go to Harvard for 5 or 6 years and invest that kind of money into something of value, something that will help you be a better trader, a better investor, and maybe even a role model to your children. That was a big reason I did that. I hope you appreciate that that's who I am. And that's what I preach. That's what I try to show. And I believe you do buy into that. So again, this is why I say thank you for being part of this community. It's not a popular community on YouTube. I don't get 100,000 views a day, but I think for the few that are here, we do legitimate work. And again, thank you for being part of that. If you can spread the word a little bit, that would be great, because I think what we do is important. And I think you're important. So, again, from the bottom of my heart, thank you very much. And I will see you tomorrow on the FX Street YouTube channel. Or I'll see you tonight at investorbootcamp.com. And for everybody else, I suppose I'll see you way out to Monday. So anyways, let's do this one more time because the world always needs it. Peace on earth. May the pips be with you. May your profits be above average. I'll see you when I see you. Cheers.